What impact does the Federal Reserve's decision to maintain its interest rates have on the financial markets? Yesterday, the Federal Reserve made the call to keep interest rates steady at 5.25 to 5.5%. While this move was anticipated, the central bank's forward guidance revealed a more hawkish stance than many investors had expected. The Fed's decision highlights its unwavering commitment to combating inflation, even if this means slowing down economic growth. The market's response to the Fed's decision was varied. The US dollar experienced a moderate rise, likely due to higher interest rates making US assets more attractive to foreign investors. Meanwhile, stock prices dipped slightly, perhaps due to concerns about the impact of higher interest rates on corporate profits. Lastly, Treasury yields saw a slight increase, reflecting investor expectations that the Fed will keep interest rates elevated for an extended period. In essence, the Fed's decision and guidance emphasize its unwavering commitment to inflation control, potentially causing continued market volatility. How is the Fed's decision impacting different markets? Let's start with the stock market. It's bracing for ongoing volatility. Why? Because investors are busy evaluating higher interest rates' influence on corporate profitability. Certain sectors, like technology and consumer discretionary, might feel the pinch more as they are typically more sensitive to rate hikes. Meanwhile, others, such as utilities and healthcare, could display more resilience. So, for those with stakes in the stock market, it's a game of watching, waiting, and potentially recalibrating strategies. Next, we move to the bond market. Here, the forecast is for bond yields to continue their upward trajectory. Investors are anticipating a prolonged period of higher interest rates, which could spell increased borrowing costs. And this isn't just for corporations. Governments too could find themselves grappling with heftier financial obligations. So, the bond market is another area where the ripples of the Fed's decision are making waves. Now let's take a look at the currency market. The US dollar is looking robust and poised to stay that way in the short term. This strength comes as investors seek out safe haven assets amid an uncertain economic outlook. So for those playing in the currency market, the US dollar may seem like a lighthouse amidst the stormy seas of economic uncertainty. Finally, we land on the housing market. Here, the forecast is for a further cool down. The reason? Higher interest rates are translating into pricier mortgages. So, for those looking to play in the property game, it's a time of reassessment and potentially restraint. As the financial landscape evolves, it's crucial for investors to consider their risk tolerance and investment objectives. Staying informed is key to making informed investment choices in this dynamic environment. The Fed's decision is like a stone dropped in a pond, creating ripples that reach far and wide. Navigating these ripples requires patience, perspective, and a keen understanding of the markets.